in San Francisco, Dylan Radigan in Milan, as we take you through the rest of this trading hour. Futures market closes at 5 p.m. Eastern. If you're joining us on the platform, tastylive.com, thank you for joining us. But come over to YouTube. Tell us what you're trading, what you think of this action. If the bears still have them right where Ilya wants them. We see a market that actually goes nowhere today. Where's the trading volume again? Bad economic data this morning. ADP, terrible. ISM services, contraction. That wasn't anticipated. What wasn't good news for stocks was actually very good news for bonds. ZN, ZB both up. Bonds, treasuries rather, higher across the curve. Likewise, good news for the metals, which bouncing back after being dented yesterday, should we say. Energy pulls back in. We likewise see a U.S. dollar pull back slightly as the Canadian dollar rallies to a fresh yearly high in the wake of a Bank of Canada rate decision. Of course, tomorrow we do have an ECB to pay attention to. So, Dylan, much to Tom's chagrin, we are going to talk about the euro here.
Oh, yeah.
Other than that, we're getting ready for Broadcom earnings tomorrow. We have non-farm payrolls on Friday. Elon Musk is out here tweeting, kill the bill, and send back all the congressmen who voted for the bill in 2025. We got to bring them back in 2026. Dylan, I don't know what the heck's going on down in D.C. But you know what? This market doesn't care because the S&P 500 is only down by 0.04%. Nasdaq's up by 0.25. The Russell's off by 0.28. The serious move in the market today comes via the long end. ZB, lots to say here in a little bit, but that is now a push to the highest level that we've seen in about 3 weeks now, vindicating perhaps a bullish falling wedge. Dylan, before we give Ilya the mic, because I know he wants to talk about that PMI report, what say you about this turn through the middle of the week? What's with this nothing of a Wednesday here?
I mean, I just think it speaks to, Tom and I were talking about it earlier, the increasing irrelevance of the Trump administration from a market perspective and the increasing relevance of normalized economic activity and behavior, whether it's earnings, pick your favorite sort of economic measurement. And in this particular instance, I think what you're seeing is, one, the marginalization of the Trump administration from the market, and two, anticipation of a jobs number on Friday and no one wanting to get in front of it and no one wanting to and everybody's sort of taking a relief. It's almost like having survived a hurricane and you're still alive and now the water is calm and the sun is out and there might just be a few days where people just lie in the boat and float a little bit and wait to see what happens next. And I think that's kind of what you're looking at here is the realization that there was a panic that there actually was that the Trump administration was going to be relevant to what happens in the marketplace based on their all the various rhetoric that was flying around. And now I think there's a recovery from that belief and a period of calm as people sort of try to recenter to look at actual economic data to see whether, in fact, I shouldn't even say whether, but the degree to which, in fact, some of the chaotic rhetoric of the last couple of months has had any real impact on something like the jobs market, which is fundamentally the foundation of the American economy at this point relative to expectations for people's ability to pay their bills every month.
Oh, yeah. Speaking of paying bills every month, we did get that ISM services report today. Services are 2/3, 70% of all jobs in the country.
More even.
More even.
Yeah.
ISM services comes in today at 49.9. Before we get into it, just the usual explainer on these PMIs or ISM reports. These are what are known as diffusion indexes. Survey respondents are given 3 choices. Things are getting better, they're staying the same, or they're getting worse. You blend all the answers together. If they're worse, it's a 0. If they're better, it's 100. If it's the same, 50. You blend them all together. 50 is your line in the sand. Above 50, the measurement is expanding. Below 50, it's contracting. And so today comes in at 49.9. Just a hair into contraction territory. But it's, of course, framed by that weak ADP report this morning. ADP coming in below 40K. I think 33K on the nose. So, Ilya, this had to be, as I joked with Nick today, admittedly, I said, this is making Ilya's morning. Ilya probably woke up this morning, poured himself a cup of coffee, right? It's before 1 p.m. Dylan, so he has a cappuccino. And he says, okay, so PMI's down. Make my day. I guess the question is, why aren't stocks down more? Because this feels a lot scarier than the February 21st report that we saw.
For the record, Ilya does not put milk in his coffee, but as he drinks his fancy black coffee, he was definitely very encouraged to see these numbers today, because when you look at the internals of these numbers, they really start to put together the architecture of the argument that I've been making for a long time. And the market reaction today really seems to comport with that as well, all of which is what you want to see as a macro-minded kind of a trader, because timing is our weakest suit. We get things wrong on the timing front constantly. And so from the price action response and from the internals of the data lining up, you get the sense that it's all kind of starting to happen. So first, the data. 49.9 doesn't look like it's the world's worst number because you're 0.1 diffusion index point away from 50. So it stands still. It's a very modest contraction. Let's be very sort of measured in the way we do this. This is not the most bearish thing in the world at face value. But when you look at the internals, they are very troubling indeed. And I won't even go into the sort of assorted comments from various industries here, from construction to healthcare to finance to retail to you name it. It's tariffs this and tariffs that, which is interesting, of course, because this is the service sector that we're talking about. Imports are mainly on the goods side. So this just tells you what people in the service sector, which is mainly serviced by domestic firms, and what those domestic firms face in their supply chains and in the behavior of consumers as a response to the tariff back and forth, that they're constantly talking about tariffs and almost exclusively about them across sectors. That's very eye-catching. But if we look at the numbers themselves, we have the first contraction of what may become a trend here, but we've certainly moved from expansion to contraction here overall. Business activity and output flat, new orders rapidly shrinking, employment stalling, and prices surging for the 96th consecutive month and at a faster clip. And the month-on-month change in price inputs, quite significant, another 3.6 index points, added to not just the fact that there's inflation, but the speed of it. And that's the stagflation thing that we're afraid of. That's what you don't want to see.
Why do you think the equity market's not more alarmed?
So what we saw as the initial response to all of this was an immediate adjustment in the bonds. And this is where I think both the equity market response starts to get explained, and also where kind of my preferred narrative starts to reveal itself in the price action. The biggest move in the bonds, and the bonds moved higher across the curve, yields moved lower across the curve. The biggest move was at the long end. The front end barely budged. And what all of this, of course, suggests is what we've been talking about before, which is that the Fed is not in a hurry to cut rates. And then rate cuts will have to get stuffed in the back end of the curve, because what the Fed is going to have to do is wait for the recession to occur or all but occur. It's going to have to wait, in any case, for some kind of unmistakable economic pain that beckons action. And that will mean that they're late. And because they're late...
They're always late. Always late.
Well, they're always late, but they're going to be late relative to themselves, right? The Fed is, by definition, a reactive institution.
For sure.
And it's going to have to be able to justify its actions. Here, the concern, as it was last year, through actually about this same period, a little bit earlier in the year, maybe about April, May, it started. Here, we're waiting a little bit longer. That the Fed is going to be later than the Fed even would be normally, and that they're going to have to do a lot of catch up. And so what the idea of later cuts will mean is more of them are going to have to occur. And so the long end really rallies here. I think that helps to explain in part why stocks are not rallying, but also why they're not selling off. Markets like rate cuts, but they're circumspect on later rate cuts. They would prefer them sooner.
Could I posit why is the Russell is, just to poke, this is what's getting me today, right? At the start of the week, we had this divergence where stocks, slow kid in the classroom, as is the case. Everything else is kind of sell America, gold up, dollar down, bonds down.
Yeah.
Today, dollar down, bonds up. Almost classic interest rate differential story. Fine.
Sure.
Dollar soft, metal's a little bit stronger. Fine. Interest rate differential story. Stocks, though, not reflecting that same type of recession fear. And the Russell today is not, if this was about lower rates, if the stocks market was excited about lower rates, those floating rate debt companies, the small caps would be a little bit more perky.
Well, and the whole thing. This is the whole thing. I think you're hitting it exactly on the head. This isn't excitement about rate cuts because those
yields are up for
now.
ZB is up for the wrong reason.
Right.
Is what you're saying.
Those would need to be coming now, right? This is stocks go, well, okay, there's cuts. Yes, this means the Fed is closer. But how much closer? Not close enough. This is later rate cuts. This is the Fed is going to be late. And there's an interesting report that comes out.
More of a risk, and there's more inflation risk than we want.
I mean, there's certainly, and what a segue. It's like Dylan is mainlining my brainstem. It's exactly the idea here that inflation is at the very least more uncertain, because you get a report from the Wall Street Journal today that follows the recent numbers from the Bureau of Labor Statistics and says that because of budget cuts, because of the hiring freeze earlier in the year as part of the now collapsed DOGE effort and various other things, the Bureau of Labor Statistics has had to significantly reduce its surveying and data collection for CPI numbers. And they've had to rely on these imputed, less reliable measures for much more of the data. So whereas before, this alternative estimation methodology accounted for maybe between 10 and 15% of the data, that's what's been normal basically since COVID. In the most recent data, the April data, it's approaching 30%, almost double. And so these are not great numbers here, maybe. These numbers, these inflation numbers now might be kind of fuzzy. And so if the Fed was looking at this and they were already unsure which side of their mandate they're supposed to prioritize, with fuzzy data, they're going to be more unsure. They're going to want to wait longer. They're going to want to really, really, really make sure that they don't let inflation expectations off the hook. And so that's just more delay. That's just waiting for more pain to become realized. So for stocks, this is kind of a confusing mix. Cuts, good. Late cuts for bad reasons, not good. so they ultimately don't go anywhere. But I think the bonds and the dollar really tell you, and gold, what the path of least resistance is here. And I think then as this data keeps getting soggier and you get more and more speculation, you get a real long runway to go, okay, now they're going to be closer. Now they're going to be closer. Now they're going to be closer. And you get this long runway for bonds to go higher and for the dollar to sell off as the market follows all of the Fed speculation around when they'll actually go step by step by step. But because that'll be long because the process is going to be elongated, there's lots of room for that speculation to be a thing we talk about.
Dylan, Ilya mentions, the path of least resistance for gold, for metals, for bonds being higher right now. I can't help but recall the fact that gold and bonds are typically the things that do best when we do have recession coming into play. And so while the last few days I was trying to sell you a story, Mr. Radigan, that things were looking growthier, right? Higher yields, higher stocks, higher oil, weaker gold. That's kind of a growth story. That's not really the case here today. Gold is up. Stocks are bonds are up. Oil's down. Oil's down despite this call between Trump and Putin. Dylan, I see the headline here, but I just got to use my own brain. Putin and Trump talking. Trump says that Putin tells him that Russia's going to have to respond to this weekend's drone attack. That seems like a scary headline, but as I recall, I think these two countries are at war.
Are they not currently bombarding each other? What's different there?
Dylan, what's the read on the Russia-Ukraine developments from Europe?
Pretty, I would say status. I would say it's not a point of focus. That there's much more focus in Europe on concern about the chaos of the American policymaking apparatus that is represented by the Trump administration, the Trump-Musk breakup, the American overall policy. I would say that there's much more discussion and concern in Europe, in the business community, focused on the disruption to the world that's represented by the American presidency than anything going on in the war between Russia and Ukraine. And that there's no sense, and maybe wrong, maybe misguided, but there's no sense that whatever happens between Russia and Ukraine, that it's any more of a threat than it was, before the latest Ukrainian maneuver of escalating outside of what is perceived to be a very deadly and catastrophic but entirely contained military theater between two Eastern European countries. No concern. And I would even go so far as to say that the whole Trump headline around, that's about Trump. That has nothing to do with Putin or Russia or anything Russia is or isn't going to do. That's about Trump wanting to position himself as somebody who talks to the president of Russia. And he's like, I talked to the president of Russia, and the president of Russia told me he's going to have to do something. Well, no shit. Like, right. To Ilya's point, like they're at war. And so I don't even think that I guess my point is that headline is irrelevant, because that headline is about Donald Trump trying to posture himself as important, to try to portray himself as someone who is in a dialogue with some other people that are important, not that Trump has magically extracted a profoundly and shockingly hard to come by piece of intelligence that he talked to the Russian president, and the Russian president told him he's going to have to respond. It's ridiculous.
Oh yeah, this headline obviously was scary, but again, what did it do to the market today? I mean, I don't want to, I hate saying this, and you and I the three of us have had this discussion for years now, where if it was Ilya, I mean, you and I came over to Tasty officially in late December 22. Mm-hmm. So I don't think we were here through. I mean, we were on Jones and Friends, right, when the Russia-Ukraine war broke out.
Yes.
But like even with Israel-Gaza, for example, I think it took like a month for the market to digest it and get into a place like where, this is going to be something that's happening. And does it suit us to react to every single headline every single day, or do we just need to take the long view and price this in as there's now a premium in oil, there's a premium in gold? It feels like the market's kind of stuck there still with Russia, Ukraine. What happened over the weekend was materially significant in perhaps a big picture sense of things. But headlines like this about there being missiles going back and forth. American Embassy just put out an alert about an hour ago that Americans in Kyiv should be prepared to take cover because intelligence suggests there's going to be Russian shock and awe. Oil is off on today's session, 1.18% lower. Natural gas is up by 0.03%. I'm not asking what this all means today. My question is, at a 38.9 IVR, given the headlines we're seeing, is oil vol underpriced? And then I suppose, Dylan, are we going to have the classic Radigan trade where we're going to get a headline that spikes oil that really has no bearing on long-term trends and we should absolutely fade it? I mean, that's where my head's at.
I mean, from a trading perspective, I would say that I'm hopeful, but I would say that the possibility of such a thing now seems to be higher than it has been in recent months, except for the fact that the market sort of like it goes back to the buy the dip conversation we had from a couple of days ago, where the market seems to be getting better and better at not even, we may never get the spike. The same way in some cases we're never getting the dip.
Ilya, if there's a spike around some headlines related to Russia, Ukraine, I think we're both of the mindset, all three of us are of the mindset that we'd want to fade it here. But square the circle for me. Like, are we waiting for a reaction, or is today the reaction itself that, yes, something's going to happen, but who cares at the end of it? There's no reason to get bullish oil because of geopolitics at these levels. We should be waiting to fade it, quite frankly.
In fairness, I've been fading it already. So if you look at that evening star on the previous test of that gray line that you have there after the most recent upswing from the range bottom around 54, 53, I've been short since then. And I'm holding it and I'm sort of waiting for things to happen because obviously momentum hasn't built, but neither has the trade been invalidated. So for me, the story is basically the same. You're stuck at a range top. The bias risk reward wise is to be short. If you're wrong by a little because you're close to a breakout point. And if you're right, then you don't need to be right by a lot. You just need to get down into the bottom of that range again, around 54, 53. And you're very much skewed to have more room to go down there than you do on the top side, considering you're up against resistance. If you break that resistance, well, then you get out because then you're wrong. But the risk reward is such that you lose a little in the test of that idea, and you gain a lot if you go the other way. So that underlying logic continues to animate what I'm doing. I think it's cute that Russia wants to posture, if that's what Putin said, right? We have to kind of filter the thing in the retelling of the president. It may not have been nearly so dramatic when it came out of the mouth of Russia's president in the phone call, but the whole thing here was that Ukraine, after aggressive and record-setting bombardment of it by Russia ahead of this operation, launched this attack and destroyed a ton of their bomber fleet, therefore degrading their ability to strike back. So this is really the whole thing. It's like, well, yeah, they're going to strike back. Of course they are. This is a war. But they have less ability to do that than they did when they were setting records for how hard they were bombing Ukraine just a few weeks ago.
Well,
So
I mean, there's a lot of speculation here, right? Like we should go to the answer,
yeah,
right?
let's go to the answer.
Who are some of Russia's biggest allies, Dylan, that you think Putin's friendly with?
China,
Who
India,
else? India, okay.
North
Any other-
Korea, Iran.
No, Iran, right? Okay, so we'll go to Twitter. unfortunately, I can't message the Russian official profile, but I can message the Ayatollah.
I can write the thing for you in Russian if you want.
No, it's fine. We'll just send the Ayatollah a message here on
Don't
Twitter.
show off, Ilya. Don't show off.
Do you know if Russia's going to attack Ukraine tonight? Sent. Maybe we'll have some news for the viewers of Overtime. Maybe the Ayatollah responds to me this time, unlike last time when he ignored my message. I just think it's funny that I can direct message the Ayatollah of Iran on Twitter.
Have you ever gotten a response, Chris?
He has not. I actually got blocked on the English account, so I sent messages to the Farsi one.
You're saying you've been harassing the English language Ayatollah so much on DM that they blocked you?
I am trying to get banned from a country, Mr. Radigan. I told you this. This is not like a shtick.
I know, but I just don't want you to ban yourself from Turkey. It's such a great country. It would be a tragedy for you to miss out on some of the fine honeyed and almond-laden and pistachio-laden desserts of southwestern Turkey. But I would say that if Iran actually did ban you, that's a response. Like, it's an accomplishment if you were so annoying to the DM of the Ayatollah that they took the time to block you
from the entire country, right? Well,
you could probably do an entire podcast where you just sit around with a screen share like we do with trading screens and just DM various pieces, like DM the Pope, DM the Russian embassy, like just go direct to
DM pieces of DM pieces of, and then you say the Pope first.
Yeah.
Come on.
DM Kim Jong-un.
He's not on Twitter.
What are you having for dinner tonight, bud?
Well, I would love to know, because there's a poly market. Like, this is part of the reason. There's a poly market. Will there be a nuclear detonation in 2025? And the conditions are, if there's a test, if there's an accidental one, a usage, right? And I'm not saying that I'm expecting a nuclear bomb to be used in Ukraine by any stretch of the imagination, but North Korea just had one of their big destroyers that they unveiled sink immediately during the opening ceremony to get it into the water. North Korea just rounded up a bunch of senior military officers and imprisoned them for the failure to get this new naval craft into the water. So what has Kim Jong-un done in the past? Have they done nuclear tests, right, to get attention? It's been years. They didn't do any during the Biden era. I think they last did them in, I can't remember the last North Korean nuclear test, 2015, 16, 17, late Obama, early Trump, somewhere in that neighborhood, right?
Been a while.
So there's some things in play here that we have to watch out. Today was an unexciting day. S&P was down by 0.06%, and those are the kind of days where it's like, okay, what pot can we stir, Mr. Radigan?
I mean, I like the thing, we just DM everybody, you're like, are you planning to use a nuclear weapon anytime in the near future, sir? And just sort of do the rounds.
That's what I would be asking Kim Jong-un.
Yeah.
He was.
But I mean, all of our sort of dark humor aside, the financial markets are not worried about this at all.
Yeah.
And they're the amount of money that is at stake in the global energy market or in the NASDAQ, which we are looking at basically all the way back from the idiot day sell-off, for us to suggest that, I mean, I realized Ilya's points relative to, the economic data and all the rest of it, but I also know Ilya keeps it small and nimble because he's smart enough to know that the market is not prevailed over by a bunch of idiots, unlike some other institutions.
Quite right.
And the market is not worried. The stock market is not worried. The oil market is not worried. And I think that I actually think that the jobs number is vastly more important than anything that Russia does in Ukraine.
I would absolutely agree with that. I think the much larger issue is growth, and growth is a function of kind of balancing tariff chaos with interest rate expectations, and that's the jobs number. That's the next big inflection point. Now, it is certainly the case that desperation can breed extreme action, but I don't think we're in the kind of realm here where Russia will be the actor that pulls the ripcord on some sort of a tactical nuke or some such thing.
Well, that Pi market bet, for what it's worth, and obviously Pi market's not available to be traded if you're a U.S. customer. But for those that do trade it, I would point out that the expiration for that contract is through the end of 2025. So, a North Korean nuclear test, Iranian nuclear test. Apparently, they have enough enriched uranium for 10 bombs now, according to the latest reports, which is why Trump is pushing for a deal. And they should get a deal, right? Like, restore the deal that we had with them previously. If you read the text of the current agreement that we're working on with Iran, it's resuscitating the Obama nuclear deal. So if that's where we go, then they don't get a bomb again. That risk is off the table. Trump seems to want that first. And I also don't think it's a coincidence that he used his comments here on his talk with President Putin in Russia to mention that he was asking Putin to see if he could do anything to get the Iranian conversation going. So it feels like there's some leverage in here on both sides, right? Putin wants the U.S. to stop helping Ukraine. The U.S. wants Russia to get Iran to agree to a deal. I'm not going to give him credit and say there's some grand bargain going on behind the scenes, right? I'm not going to say there's some 4D chess here. Far too gratuitous. But these aren't unrelated. And today's lack of reaction to the news story, Ilya, I think does serve the purpose of telling you what was important today. So if we look to our cross-asset performance, if Monday was growth, today kind of feels like recession. Today kind of feels like
don't you think that we're also in a world where this jobs number, and I don't want to steal the thunder from tomorrow's conversation, but where this jobs number is going to be one of those ones where if it's a strong jobs report, the market, good news will be good news and bad news will be bad news, basically. That if there's a strong jobs number, that will be unexpected and supportive of the ebullience of the equity markets, for instance.
Ilya,
or is a strong job number going to eliminate my rate cuts and cause me to have agita?
Well, so I think this is why the response today to weak data is so interesting. We know the stock market likes going up. We know it's biased to interpret things in ways that allow it to do that. And today, it got bad data that it could not interpret in its favor, despite the fact that yields fell across the curve. In my mind, the way you explain that is it's because the rate cuts are coming later and because the Fed is not going to be sold. So if you go and you get a weak jobs number, I think the market isn't going to like it whatsoever. And I think the reason the market isn't going to like it is because it's going to say, here's the downturn and the Fed's not coming. There's going to have to be a lot more for the Fed to really jump into action. And by the way, the fact that the president is back to goading Powell to cut rates probably means that the Fed goes even slower because they don't want to risk their credibility. So in my mind, it's probably bad news is bad. Good news is we'll see. Because either way, you get a good jobs number. Okay, rate cuts are delayed, but maybe that's not so scary if the economy is all right.
It feels like there's how we talk about narrative flexibility with like Bitcoin or gold, where no matter what happens, you could still kind of fit the square peg into the round hole of this is good news for the asset.
Sure.
I kind of feel like we don't have that with the jobs report on Friday. I mean, sure, we had the JOLTS report, which is very lagged for April, shows an improvement. And there's the quirk that we do get the China-U.S. trade detente during the NFP reference week before you'd actually start to see all of the port layoffs and trucker layoffs and retail store clerk layoffs, right, begin to domino here. There's part of me that says the data are stale and don't reflect the world that we're heading into. There's part of me that says the data are going to be better than what I think people are giving them credit for. There's also the potential for them to be terrible. So if they're good, Ilya, you go, well, ISM services for May. I mean, like, awful, right?
Yeah.
Like we just, there's more pain coming. I can ignore a good number here. Forward-looking indicators, more contemporaneous indicators are telling me that things aren't getting better.
Mm-hmm.
Dylan, I'm having trouble trying to find where is the jobs number that convinces people, you know what, we need not be concerned anymore. Is it 400K? Is it a million? I don't think that the estimate of 130K is going to cause anyone to turn around and say, see, tariff problem avoided. We're good.
Yeah, but don't you think it comes in at like 227?
I think it does have the potential to beat. Especially because ADP was,
and then everybody's like, the tariffs, no one's getting laid off. Not little Goldilocks vibes, not too hot, not too cold. Rate cuts are still in play. Tariffs aren't that bad. I mean, I'm not saying that that's what's going to happen, but that seems to be the sweets. That's where the narrative flexibility comes in. I think your worst case, but maybe your worst case becomes your best case, is you get minus 200, and it's sort of tariff catastrophe comes home to roost.
I'm sort of the mind that if you got minus 200, the markets might actually go, you know what? Fed's coming. This is fine. This is a legitimate hair on fire, holy moly number. Okay. They're coming. They have enough. And if you get anything middling, like you'd have to get, to Chris's point, some sort of incredible jobs growth for the markets to go.
843.
This is not just lag. This is a real thing that you can extrapolate as labor market strength. Everything else is whatever. Surveys, blah, blah, blah. This is a really good number. And yeah, there's not going to be cuts, but the economy is doing great. On we go. The worst case scenario, but also the much more likely scenario than either of those things is something middling. And if you get, and the likelihood, I mean, that's the meat of the curve, which is why I think Chris is absolutely right. It's difficult to have narrative flexibility with this number, but for if you get something on the tails on either side. If you get something on the tail at the super weak side, okay, great, the Fed's coming. If you get something on the tail at the super strong side, we're all wrong. There's no recession. All is well that ends well. But the meat of the distribution is the biggest fear of all. Because that
come in at $1.25, 90,
yeah,
$1.25, $1.47.
Things are slowly dying by 1,000 cuts, and the Fed's
weak sauce. Mm-hmm. How about buying the bond then?
Well, what's the worst case? What's the worst case scenario? I mean, if you get let's just say you get. We're going to talk about this tomorrow. But
worst case scenario is a weak sauce.
No, but let's say there are three outcomes here: minus 200, 0, and plus 200. Plus 200, I think everyone ignores. 0, everyone panics over. A negative print is the most bullish because then the Trump administration is going to tap out. Elliot, is that crazy?
I mean, tap out. Say more about how you envision tapping out in this context.
Well, the
tap out was on the W. Bro, didn't you see when Donald Trump was on the WWE? Like, he taps in, he taps out. He knows how to do it.
You know what? I actually recently saw the Netflix documentary on Vince McMahon. So actually, I just
the clip. You know what I mean? Donald Trump is an entertainment professional from the World Wrestling Federation, bro.
That's right.
In and tap out.
But this is then becomes the question, right? Does tapping out mean forget the tariffs? We're going back to a 2%.
It means forget the tariffs, and it means back to the drawing board with the big, beautiful bill.
If that were to happen, let's say here that we don't have a president that is absolutely incapable of saying that there was a mistake made.
He doesn't have to say there was a mistake to change his mind.
Right, but I mean, how often does that happen? But now it's also a president. It's also a president that can that has enough flexibility to say, "I'm saying this now," and if somebody says, "But you said this other thing before," he goes, "No, I didn't."
Of course,
then
that's just
and then that's it. And then that's it. So all of those things, yes, but if we were to say back to a 2% tariff, back to the drawing board on the big, beautiful bill, tax cuts, whatever, I think the markets would absolutely rip. I would become bullish pretty much overnight, because that's the kind of morass and inaction for an extended period that markets love. Because then that means Washington is probably not getting in their way for a while. And they don't have to think about it. How likely? I don't think that's
be in the way for a while. Ron Johnson just made the rounds, 2 hours ago. He was on CNBC saying that he's not going to vote for Trump's bill in its current form. My congressman, Mike Lawler, put out a statement today saying that if the Senate Republicans send the bill back with any changes to SALT, the SALT caucus is going to kill the bill in the House.
So that just suggests it's neither big nor beautiful.
It's kind of neither big.
It's big.
It's beautiful.
Big. It is big. It may not be beautiful.
But it may not be beautiful.
I mean, I think the problem for these Republicans is that, in fact, it might be too big.
Dylan, I know that we have
the three of us get disgusting abomination. Sorry, I had to get it out of me.
The three of us, I read the chats. They say it's not good for your mental health to read the comments. I was born in the comments. You've merely entered them. Okay. I grew up on 4chan, on Reddit, right?
Wow.
Okay. So none of the comments bother me. I would posit that the people say that we have TDS for doubting the viability of the bill and that it's not going to work and that Doge was a joke. You have the TDS. You're so unable to see what the actual law allows for. If you want to codify the cuts that Doge is doing, you have to go through a rescission process, something that we've talked about here on Overtime. We've talked about it on The Price of Truth. The president just simply can't say, like, I don't want to spend the money that Congress is appropriating for me. That's not how our country works. There's also no fraud happening. If there's fraud, it's illegal. Sue for it. Where are the lawsuits? It's just spending that people don't like. And cutting the spending is much more difficult than people presume. So when we're saying that we don't think this bill really is going to go anywhere because of Ron Johnson, because of what Elon Musk is doing, because of what purple seat congressmen like Mike Lawler and these California and Illinois Congress people are saying in the SALT caucus, because we're trying to stay tethered to reality. We're trying to stay objective here about what is feasible and what is just a pie in the sky. And it's just campaign talk, right? Like, it's why, for the life of me, when I hear, the war in Russia, Ukraine is going to end on day one, and people are sending emails like, okay, if this happens, what assets should I own? We have to start with the first premise, like, this war is not going to end on day one. Why are you taking that face value? What would make you even think that's the truth or possible here? Oh, it's just a sales pitch. Okay, well, then why are you suggesting that I need to identify assets that would benefit if this war ends on day one? Pick a lane. Pick a lane.
Hang on a second. Can I just ask a question? Are you talking to Iliad and I, or are you currently debating the chat room?
Debating the chat room. Fighting the audience.
I thought that you kind of just, I feel like you might have just broken the fourth wall, left Iliad and I here just to sort of enjoy the program.
I mean, I'm just sitting here.
While you've gone into a direct
with everything Chris is saying.
You're doing a good job.
Go.
I agree. I'm with Iliad. I agree. Carry on.
Go on.
This is kind of sucks for the era that we're moving into right now. And I made this joke with Victor, and I think I've made this joke with you guys, but when I was a little boy, I thought the future was going to be flying cars. Not me tweeting something innocuous like, the earth is round, and someone responding to me, at Grok, is this true? So I would encourage everyone, don't use AI. When you see something like Doge announced, or you see a spending bill announced, take the time to actually read it. Take the time to figure out what the law is behind it. And is this a market reaction we should actually be taking to heart? And I bring that up because how many times have we been confused about this in the past week? I recall a market that overreacted last week to the announcement that the International Court of Trade was no longer going to allow those tariffs in place. But a simple read through of what the court order said basically redirected the administration to Section 122. And so by the next morning, when the administration had said, we're just going to do this through Section 122, the market rally was undone. Because people who were reading the actual court decision said, oh, this isn't going to last. I should fade it. So take the time and educate yourself, right? There are politics in play here that matter. Saying that we don't think the bill is going to pass isn't TDS. It's the actual nuts and bolts of what the senators and congressmen are saying. Maybe that's behind
the richest man organizing the primary. Anybody who votes for it doesn't help.
That's also, I mean, listen, let me just, I know Trump is the guy. He's the best thing since sliced bread. But if you are a 45-year-old congressman in the Republican Party right now, do you put your chips in Elon Musk corner or the octogenarians corner? The guy with $400 billion in the bank?
Great point.
Or the guy who is term limited?
That's a great point.
I think today's ZB move is just as much. We were freaking out last week or 2 weeks ago. We have this May 21st move. Oh gosh, the bonds, the deficits, the debts, the horror. Maybe the bonds are reflecting.
Steve Eisman, oy, the deficit.
I'm just, Dylan, maybe today's bond move isn't just about PMI and the ADP report, but also about the fact that this deficit blow up, this debt blow up bill isn't going to get passed. And so all that additional issuance at the long end of the curve isn't going to have to come into the market. I'm with Tom Sosnoff here as I get off my pedestal and I stop filibustering. If there are weakness in bonds notes over the next few days, particularly with non-farm payrolls on Friday, I'm a buyer of that dip. Not just short put spread, but given the falling wedge here, I'm looking for an opportunity to get in to buttress. Well, I'm already in here at 51 days with Nick Batista today, but go out to 79 days and do something like long the 121, short the 125 call spread. It's a 10-1, Dylan. It captures the top side of our falling wedge base, which is 121 and 10 ticks. I think we could take a madman's delight here and queue up a 10-1 shot, basically 1 in 5 probability. Long bonds, long into the curve. The bill's dead in its current form. You're not getting the debts or deficits.
Jobs number is going to be a mixed bag, will be useless, not helpful, won't be too strong, won't be too cold. It's going to be a middler.
And let's pay some respect to our friend Ilya here. The data are showing, growth earlier this week, maybe not so much growth right now. A long bond position 79 days out is as recession classic as you could get in terms of where to put your money if you think recession is coming. Yeah. Because since 1980, it's been and gold that has outperformed everything else when recession arrives. So I'm done speaking for a bit. I've been bothered by some of the comments, seeing people accuse my friends Ilya and Dylan of having their blinders on, and yet you guys were ambivalent about saying Doge would fix anything, given your experience, Dylan, yours especially in politics and financial media since the global financial crisis, right? Like you know how this all works. So let's just not ride narratives here. And if we're riding narratives, I fall into this myself. This is a good check for me as anyone else. But don't just believe the headlines. Okay.
So now can I switch to my completely contrarian, sort of contrarian to myself anyway, perspective, which is that yes, long the bond, great, fine. I like silver, as we know. I would, if oil spikes on Russia, I'd sell it. But what of the madman's delight trade that is a short NASDAQ position? That the market is on the wrong side here. That the economy is slowing. That the war risk is higher than we want to believe. I mean, all the risks are more. List your risks, and run and because the levels are so high. The NASDAQ's basically been going up for a month and a half.
So I have this on, but if I have it on through a put vertical in the Qs. And if I didn't have exposure, I would not be putting it on now, though I'm not unhappy enough with it to take it off. I didn't like that we closed above the range top yesterday. We talked yesterday. I mentioned that if there was a blemish on my bearish narrative, this was the glaring one. We're still underneath the spike high on this move higher. And that's why I'm not convinced to get out. So if you look, 4 candles back, or 3 back from the current candle, 4 candles away, that's that spike red right there. We haven't cleared that high. So I'm not convinced to get out of my position. If I was going to take a bet here, a new one, and deploy an incremental dollar, I would be looking at the S&P. And I would be looking at the Russell. I think Russell maybe in particular, because that's a growthier, more sensitive kind of thing. But the S&P just as attractive from the perspective that it's had a bigger run and there's more to unwind speculative sentiment-wise in the S&P than there is in the Russell. The S&P has outperformed.
I mean, if you're long the bond and short the NASDAQ, are you basically long the same thing?
Yeah.
Kinda.
If you're playing the recession trade?
Yeah.
If that, yeah. So that's...
I mean, I'm also arguing NASDAQ.
Exactly.
Sorry.
No, so just to voice endorsement of what Chris just said, I think if the reason you're selling NASDAQ and buying bonds is because you're minded toward recession and not for some other reason that you think the narrative is going to take some sort of weird turn, if that's the reason, it's the same idea.
So would you rather be long, if you had to just gun to your head?
That's what I'm about to say.
Long the bond or short the NASDAQ? I'd be long the bond.
I think you got to be long the bond there, if only because we've seen that the stock market is willing to get ahead of itself and say growth is going to be low, but sunnier days are ahead, whereas the bond market will stay at lower levels for a longer period of time, reflecting those limited growth and inflation premiums in the short run. So stocks tend to bottom first. They tend to lead everything. So, I mean, Ilya, the question that I think we are dealing with now is traders, right? Maybe not traders that are doing it the typical tasty way, who are simply looking at the vol and looking at, the 45 in, 21 out, and they're ticker agnostic, which, quite frankly, sticking to the mechanics is, you and I should probably do that more. And I think that we get in our own way sometime with our own narrative. Sure. But there are other times when we may be early, but because of the macro, we're right. And then there comes that's the convexity, right? So keeping that in mind here, over the next 45 and 21 day out window, are we likely going to get clarification as to whether or not we should be pricing in recession, which we may already have back in April, or do we still need to yet price in stagflation, which is not an overheating economy. It's like an economy that's frozen. Nothing thaws, nothing clears. Prices stay high, activity stays low, right? It's frozen in time, basically. This is not pricing for a frozen in time economy, for a stagflating economy. Even if recession does come, the stock market's like, well, it's people induced. This is not like nature having its way. So maybe we started it, we can stop it.
Yeah.
I'm just going to take the view that right now, non-farm payrolls poses its own risk. The volume today was nothing, Dylan. So if I wanted to call the top today, 1.05 million traded, gross. That should be where we are at the halfway mark. So there's no volume. There's still positive technical drift. The slope of the moving averages is more positive today for the 1 week and the 1 month than it was yesterday. We're more overbought than we were today than we were yesterday as stochastics. And MACD is flattening out, getting ready to turn higher. And it's a summer. It's June. I mean, it's not officially summer yet, but like June, July, August, this is kind of just a melt-up market. I don't know. Today, this is not a market you fade when it's boring like this, I guess is my point.
I agree. I mean, the only thing that you would do here if you wanted to do it is if you looked at the S&P and said you're at the top of the range, much as we just did with oil, by the way. You look at the top of the range and you say, okay, we're at the top And because we're at the top, the risk reward is better to be short than it is to be long. If you're wrong quickly and by a little. And if you're right by more. And if you want to do that, you need duration and you need risk-defined exposure and you need small size. Because then you're not, as it were, shorting a boring market, because you're not shorting this market today. You're not shorting today's price action. You're looking at the overall structure and you're going, the risk-reward is appealing to be on the short side, but I'm going to give myself like 60 days to expiration. I'm going to use verticals, so I'm going to lock in my risk. IV is only 14.7, so it's super cheap to go out there and just buy some puts. I'm going to do it as a vertical, so I'm going to keep my risk firmly contained. The worst case scenario is in like 2 months, this thing has to expire. Worthless at a manageable loss. Okay, yeah, fine. I get that. But if you want to say, okay, I'm shorting today's move, yeah, I wouldn't do that. It's a boring day, and you got big event risk. You probably get a little bit of a digestive day tomorrow where nothing happens. Asterisk, Truth Social post risk.
Mm-hmm.
But
we're gonna have to talk about it tomorrow.
Yeah,
because overtime is out of time.
There it is.
Getting the tap from the producers. Don't want to run over again today, but hey, it was a good session. We're done. We'll be back tomorrow, same time, same place, 4 p.m. Eastern, 3 Central, every Monday through Thursday, right after last call. So for Ilya Spivak in San Francisco, Dylan Radigan in Milan, I've been Chris Vecchio in New York. Stay tuned, though. Tasty at Night continues next. Ilya's sticking around. He'll be back with Macro Money. See you there.
See you there, everybody.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
I had to rewatch that market measures from this morning, Bodacia. Our raid really distracted me. I was like, get away from me, uncontrollable fire.
I told you, Tasty Grax, you can't plunder with headphones on. Light pillaging, maybe.
Sometimes I'll hide in a gross peat bog in the middle of a raid, just so I don't miss market measures.
I'm only recently comfortable admitting this, but I think I trust market measures more than I trust my savage hellhorse, Arbitrageur.
God, I forgot to tell you guys that I slaughtered a horde of conformerons this morning. Did the whole terrifying row of severed heads on pikes as a warning thing, but you never know with those idiots.
Okay, thanks for the heads up.
Ha ha ha! Goblets of hot blood for everyone.
Nice.
Thanks, you guys.
Normally I hate puns, but that one was okay.
Got the need for speed? No problem! At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade, make your move.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
decision to build Thinkorswim was a byproduct or derivative of 20 years. In our minds, the future of finance meant that we were going to move away from something that was very manual and move to something that was tech-driven.
What we did with Thinkorswim truly changed the industry. To do it a second time was a challenge that I just had to take. The platform is just leaner, cleaner, a little meaner, legitimately built from scratch.
One of the things that was most intriguing about the financial space to us is just that there wasn't a lot of vision. There wasn't a lot of innovation. After almost 20 years of open outcry standing in the pit trading, I felt like all the markets were moving to electronic trading. I saw the writing on the wall, and I wanted to be first. Building the best technology in the world for traders was one of the coolest things anybody could ever do. I loved every second of it.
Thinkorswim will always be my baby, but this one, it's different. We built ours literally from scratch. It's a much thinner, it's a faster, it's a slicker application. Everything's on one page. So you're always looking at the core page and then bouncing around from there to get to whatever you want to get to. We're here to support whatever you're looking to do. We have the tools that you need to be a successful trader.
When you've got a futures contract that's in contango, what does that mean?
Futures, unlike stocks, have multiple prices appropriated to them. That's known as the forward curve. So when a futures forward curve is in contango, that means that the front month is trading cheaper than the corresponding futures back month. So you'd see that forward curve most likely looking like this in terms of prices.
And backwardation, what does that mean for futures contracts?
Backwardation is the opposite of contango. So where contango front month futures contracts are trading cheaper than the back months, backwardation is the opposite. So those front month futures contracts are trading richer than the corresponding back month contracts.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Another quiet day for U.S. stock markets, but bonds rip after some very eye-catching U.S. economic data suggesting the Federal Reserve is going to have to do a lot more in terms of cutting interest rates just later, not sooner. Fed has, of course, been very resistant to cutting rates as it tries to figure out whether it should prioritize growth or inflation amid the tariff scare. But one central bank that isn't afraid to cut interest rates and is going to almost certainly cut them again in less than 24 hours is the European Central Bank. They are due to make another move, and we're going to try to figure out what it all means for the markets here on Macro Money. I'm Ilias Pivac, head of global macro here at Tasty Live. What we're going to do here is take a look at what this means and what this might do as a trading proposition for the markets, because there is a trading proposition seemingly to be had, even as the markets appear to be firmly in agreement, at least about the actual step that the ECB is likely to take next. Here's the expectations range here. Of course, the current ECB deposit rate at 2.25%. We can see that here. And for the June contract of the benchmark ESTR futures, this is Europe's equivalent of Fed funds futures, we can see a 25 basis point cut down to 2% is firmly priced in. So the markets know that this thing is coming, and that is then not really a point of speculative interest. If the move is already on the menu, then there isn't very much to say about what it could mean for speculators, because of course it's already been discounted in markets, and so it shouldn't be particularly market moving. The next question, of course, is what will be market moving, and since the move itself is already there, then the real question is what happens next. And we can see here that between what happened in March and now, we've had a meaningful shift lower in the entire curve. So it isn't just that between March and April going into now this meeting in June that we've had a shift in some of the more recent moves. It's that between March and now there's been a considerable dovish adjustment in the entire pathway for the curve. We can see rates now expected to end up much lower than they were even just 3 months ago. And so we'll look at what's going on here, because the adjustment here is, needless to say, a critical one. We can see over the course of the remainder of the year, so after this cut, we have the markets priced for at least one more cut on net over the course of the rest of this year and next. And the way you get there, you can see, is 34 basis points in further easing are priced in for this year. That means at least one more 25 basis point cut and a 36% probability of one more thereafter. If you look at then what happens next year, there's a 5 basis point uplift. So there's a slight hawkish bias, very slight, we should point out, to what is expected to occur next year. That 5 basis points accounts for just a meager 20% chance that we are going to have a rate hike next year. So the overall kind of market bias here seems to be in favor of standstill, and with quite a meaningful level of conviction. So that's the sort of backdrop against which the markets are going to read the statement from the Governing Council, hear what Christine Lagarde, the president of the ECB, has to say, but then also parse an update of quarterly growth and inflation forecasts. The ECB last updated this in March. That's why the shift since March is so important. And the new update is coming this time. So they're going to have all kinds of fodder to try to see if what they're looking at here, that is one, maybe two cuts this year and nothing next year, if that's still the path forward that makes sense. Here's the latest set of updates and how they compare with what the ECB said in December. We can see here that the outlook for growth in March was downgraded versus December. The outlook for inflation was upgraded, though core inflation, so excluding energy and food, was relatively steady. Probably the most convincing bit here is that inflation has slight bias higher, but it looks like not at the core, and growth has a downside bias at least this year and next based on these projections. Now, the ECB has been very, very clear. When it published these things, it said this includes tariffs as they'd been announced up to that point, and that includes some of the tariffs on China and a little bit of the back and forth with Mexico and Canada at the start of the year. But needless to say, this does absolutely nothing to show what forecasters at the ECB think post-Liberation Day. Liberation Day in the U.S., this, of course, the day that reciprocal tariffs were announced and spooked the markets. None of those things are in this forecast yet. And so there's room for all of that to still appear. Now, as it stands growth-wise, the situation in the Eurozone is certainly not a happy one. We have the composite index here for the PMIs. In fact, these numbers were just updated over the past 24 hours from S&P Global. They released the final set of May's numbers. And we can see they're ever so slightly better than the initial release. The first estimate was that actually the whole of the economy contracted in May. As ever, these PMI numbers are centered around a neutral level of 50. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. That composite number was in contraction mode when the initial estimates came in. It got revised to basically standstill. Nevertheless, both services and manufacturing record a narrow contraction in May. So the economy here is, let's say, at best, idling. Now, against this backdrop, the latest CPI numbers tell us that we're back to the ECB's target. We're down to 1.9%. That's the lowest since this spike low to 1.7%. We can see that was short-lived, and we kind of edged back into the top of the range, largely as this wedge of additional positive contribution to inflation from this category right here, housing, water, electricity, gas, that's energy prices, it started to rebuild here. We can see this was, of course, the shock from the Ukraine war starting. Then there was a statistical adjustment where that rolled over out of the numbers, and we can see that as this normalizes, we rebuilt this back right here. And so we had this spike down to 1.7. We rebuilt it as the numbers kind of evened out, and now we see a more pointed effort to get lower, a more even distribution for these various components of CPI, and perhaps even a more sustainable one. And so this looks like the kind of disinflation that the ECB may want to see. This, of course, is encouraging of rate cuts. And if we look at what bond markets are suggesting, it seems they envision more of the same ahead. These are break-even rates. They're for Germany, which is the benchmark economy for overall Eurozone performance. It's the largest still in the region. And of course, there is no such thing as a collective Eurozone bond as such. In fact, Germany resists the creation of one, even in the current iteration of the government under Friedrich Merz, at least as far as lasting Euro bonds are concerned. And so this is our benchmark for sort of figuring out where inflation trends are going, because largely as they go in Germany, so too the region as a whole. And we can see here that after a brief spike in March, again, hold that thought because it is relevant. March is an important inflection point here. These things have started to trend lower. Now, the way you arrive at these is you take the difference between nominal bond yields and real bond yields. And of course, the difference between nominal and real is real extracts inflation out of the calculus. And so if you take the difference there, then you see what kind of an inflation adjustment there is. And so you get the sense of what the bond market's inflation expectations are. So you can see here very clearly that near-term inflation is biased over the course of 7, 8 years or 5 years, sort of the relatively kind of medium-term window and a little bit more. It's biased below the ECB target. And you really only get sort of slightly higher readings, but very much sort of contained as far as ECB objectives are concerned. Here's the 2% target. You're a little bit higher, but nowhere near sort of challenging what the ECB would say is an inflation risk, at least not here. So the bond market seemingly saying we're going to have low inflation, it's trending lower. That makes sense. The economy is weakening. And from that perspective, the ECB might well need to be more dovish, not less. Of course, as we just saw, the outlook is relatively modest. Rate cuts seen happening for the rest of this year, maybe one more after this one, maybe two, but next year, nothing. And the fact that we haven't factored in these tariffs in their wholeness, or at least made the attempt in ECB forecasting, that may set that stage. We can see here that the U.S. runs a trade deficit with Europe. Of course, the president rails about it often enough that we would know that. But we can see here that, indeed, the tariffs might be a disinflationary force for Europe, because if they mean that Europe has to sell less to the U.S. because tariffs undermine demand, well, then you would get a hit to the economy of some magnitude. Obviously, we're still back and forth on what kind of tariffs will happen when, but in so much as the Eurozone exports and derives positive contribution from those exports for its economic growth, and that's its relationship with the U.S., tariffs in that they might undermine those exports, they would be something that you could factor into the equation here and say, well, this is going to be a further headwind to growth. And on that basis, lower forecasts for growth, lower forecasts for inflation, and perhaps then get to more rate cuts. That is certainly one way that this might go. However, if we take a look at what's happened so far, and obviously this data is a little bit more timely than what's happening with ECB forecasting. This data is more recent than that forecasting. We see here that actually we have a fairly convincing rise in U.S. imports from Germany here. And of course, the latest numbers look particularly heady, but that doesn't necessarily sort of jump out. We've had similar kind of rises here. It is certainly notable that there's been a push through whatever congestion there was here. So maybe there's a degree of acceleration, and maybe this is tariff front running, one might say, much as we've seen with relationships elsewhere. Maybe this is just a way to kind of consider that what's going on here is the markets attempting to front run what may be greater tariffs, and so there's more stocking of inventories. But if we take a look at how this has worked month to month, I mean, you can clearly see that in the case of China. So in January, you see this massive surge in imports from China. And since then, things have kind of cooled off because the front running was so dramatic. You don't really see that in exactly the same way in Germany. We'll, of course, have to watch it and see, but you get this sort of jump in January, then things cool off considerably in February, and you have a similar pop to January's in March. So it doesn't look like you're sort of jumping out of the window, as it were, on the volatility in these statistics the same way, for example, that you would be in Mexico, where you have a giant surge, the same way as Canada, where you have a giant surge. So all of these kind of usual suspects for the trade war so far, the members of the USMCA and China, you get wild swings in the double digits. You don't really get that in Europe. So it's unclear, really, how much this front-running matters. But if, in fact, the bond market is already telling you that the way that inflation is going to trend is lower, and that's been happening here for a while, well, then chances are you've priced in a degree of disruption from the tariffs already. You've accounted for whatever this front-running might imply would happen as a cool-off downwind. And so the markets are still only priced for this modest setting. So it doesn't really seem like the risk here is going to be that great, surprise-wise, speculative, unhinging-wise, from a ECB that meaningfully revises down growth and then inflation expectations. Rather, the risk seems to be on the other side, because that's what the markets ostensibly aren't readily priced for. And that comes by way of Eurozone defense spending. Of course, much was made in March. Again, remember this reference point. We were up here in March. We're in a very different world now. And if we look at what happened in March with these inflation expectations, they surged right here. Things have cooled off since. They've cooled off since because growth has cooled off since. See that right here. But what happened in March still happened. That was this giant effort by the Eurozone and the EU more broadly to rearm, as it worries about Russian aggression and the, let us say, diminished reliability, at least in their mind, of the U.S. security blanket. Now, there's a number of these things that are still in the works, in particular this one right here. But this part, this is already done. As of the end of May, as a matter of fact, the 27th was when the authorities approved this part of the plan. And so we are looking at perhaps a meaningful fiscal boost for Europe next year that is likely to drive up growth, drive up inflation, and perhaps boost inflation expectations from their current lows. And so where this, of course, becomes exceedingly interesting is the possibility that it isn't so much that the markets are priced wrong for what is likely to happen because they're not dovish enough. It is perhaps that the markets are wrong because they're not priced hawkish enough. And to the extent that the ECB decides to include forecasting for defense spending as a boost to growth in its math, these expectations might actually surprise not in the dovish direction, but the other way. And they wouldn't really have to surprise very much because, indeed, you wouldn't really have to do a whole lot with how much is already priced in, which is, again, modest. And so with that in mind, you'd need just a little bit. Now, there has been some back and forth as to whether the authorities there can get it done. We just heard earlier today that Denmark has decided that they're out of the so-called fiscal four, or frugal four, excuse me, that was trying to push back against more spending. They're minded on rearmament. We see sort of similar vibes out of Germany, which before was on the relatively frugal side of things. And we're reminded of how this tends to work in the Eurozone. This is a model based on the optimum currency area theory that was developed by Robert Mundell that explains how a country chooses to integrate deeper, chooses more currency union, more European Union in this context versus less. And you can see here, it's where the costs are less than the benefits to greater integration. And typically this is done in terms of saying, well, if you unify everybody under one central bank and the economies are already very close together, well, then the benefits from more frictionless trade outweigh the costs of giving up independence over your monetary policy. And so benefits outweigh costs. And over here, if you can make this calculus make sense, that's where a country might be pushed, or groups of countries might be pushed to greater integration. But what we find is that when you consider defense, countries will accept a lower degree of integration if there is a defense shock to this model. Because obviously, if an economy can prevent war, or at least taking greater steps to prevent war by spending more on defense, well, preventing your industrial capacity, your economic capacity from being destroyed by missiles, that's an economic good. That's an economic benefit. And so when you get that kind of a shock to the benefits part of this model, such that the benefits part grows because no war is better than war from an economic perspective, you see that the effect of doing this is a less demanding thing on integration. You will accept less integration as a consequence. You will be more inclined to join such efforts, which starts to explain why countries are jettisoning their resistance and signing up, much as Denmark now has. If you get then the likelihood that this passes in all of its 800 billion euro glory, and the ECB has to account for that, well, then their forecasts may indeed be more hawkish, and the euro may well push through this resistance just below the 115 mark, and then these highs at 116 are but a stone's throw away. If you breach those, well, then the next big leg in this big euro rise from lows near 102, then it continues. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime. My show I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may go therefrom. I'll be back in just 30 minutes' time with Victor Jones for the Price of Truth. Back with Chris for Futures Power Hour on Friday. With Victor and Tom for First Call on Sunday. Writing for the News and Insights portion of tastylive.com. Commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. Like and subscribe if you're watching on YouTube. Macro Money's back tomorrow.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move. The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from tastytrade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. tastytrade. Download today.
tastylive's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging, and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number 1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. tastytrade. Make your move.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with tastytrade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the tastytrade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Global markets never sleep. Explore them with Forex, now available on tastytrade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on tastytrade.
When somebody says tape action, what do you think of?
To me, tape action is a little bit of a historical term because that.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to tastytrade. So spread the word and earn rewards. Terms and conditions apply.
Welcome back to the Tasty Crypto Show. I'm Dan Cecilia, and with me today is my co-host, Shelly Van Witzenberg. How are you, Shelly?
Whoa, you full named me.
I did full name you.
Hello, I'm well, thank you. How are you?
I'm doing all right. We got a great show today. Filling in for Ryan, but we got a lot going on in the market. We're going to be tailing some of Ryan's trades, which are now available in the platform, and we'll be going over some of the performance dashboards that we put together in the newsletter. So, yeah, how are you doing?
Cold.
Yeah?
Office winter has kicked in now that it's nice outside. So yeah, we have blankets at our desks. It's silly. I'm excited to be here. What is up, chat? See some friends in there. Do we have a question for the chat?
Yes, we do. What is your favorite rainy day activity?
Let's hear it, chat. What are we doing on the rainy days? I love my Kindle. So when it's raining outside, I feel like it's just an excuse to do nothing physically and just read all day.
What about singing in the rain?
No, there will be none of that.
You're not a big singing in the rain type of person?
No.
Okay.
You?
No.
Okay.
I can't sing to begin with, so.
Yeah, that's the thing. If I could
rain
sing,
or
maybe.
shine, I can't.
Right.
Yeah.
What is your rainy day activity?
Trade crypto.
Of course. I mean, there's always that.
Sit in my office and trade crypto.
What are we doing on nice days then? If just trading crypto all day,
Trading
every
crypto.
day?
Definitely.
Okay. Let's see. In chat, Wet Juice
Emmett
Box.
says sleeping.
Sleeping. That's a good one. Wet Juice Box on X says, if it's not pouring, I'll go for walks during the sprinkle. Love it.
Okay.
I like that.
Wet Juice Box, who is one of our followers, he's deep in the trenches too. Paying attention to meme coins specifically. So, Juice Box, if you have any tips, send them our way because we're always looking for
hot alpha,
new trades, alpha. Yeah. Juice Box is convinced that he has alpha from the trenches. So,
let's hear it.
Yeah.
Let's see. JDD on YouTube is saying, finding all the leaks in my roof.
Yeah.
Pots and pans out there collecting the drips. So, what are we doing today? We're going to get into.
Well, we're going to go over some of the performance dashboards that we put together in the Wednesday newsletter went out this morning, just to give an update on where the market's at. And then we got an update on the platform. Specifically, we have follow feed enabled for crypto trades. So Ryan has been placing some trades recently based on some of the stuff we do as far as like ranges and signals that he gets. So he's got a couple of trades that he put on, and I think we're going to tail them. I believe. At least I am.
I already did.
Yeah, Shelly front ran me. So.
Wet Juice Box is saying buy OKLO and DLLM Fartcoin. LMM Fartcoin. So.
Okay, so
there's our trench alpha.
I did the Oklo trade and made a ton of. I did follow the Oklo trade.
I did not.
Yeah.
Although I time-stamped when we brought that up, like in our text messages, 'cause I always have my notepad on my phone open, and I put in there, OKLO, look into it. And so time-stamped was like May 16th. And if you look at the chart, it's like, damn.
It's like a day before it ran up. Yeah.
Like, man, that would have been a good one. So yeah, go ahead, pull it up.
Oklo?
Yeah.
Yeah, can we get our, yeah, there we go. So it's a 1 week chart. Let me clear this. Go to a day.
Mid-May. Oh, here we go. We were right before, not at the bottom, but pretty close to before that pump.
That's insane.
Mm-hmm.
514. Okay. Yeah, right here.
Mm-hmm.
Look at this gap up. Yeah, the other thing I did with that is I think I started buying early May, and then I was selling covered calls against it at the top because it was so volatile that the premium on that was insane.
Mm-hmm.
So made a pretty decent return there. It was crypto-like price movement for sure.
Yeah. And for people who aren't familiar with this, what is Oklo?
It's a nuclear reactor development company.
Mm-hmm.
Has a contract with the U.S. Department of Energy. They don't have a product and they don't have revenue, but they're building these more efficient nuclear reactors. And apparently the delivery date for them is not till 2027. So this is just pure speculation, which is trades like a crypto. So, that's why we're covering.
Yeah.
But more specifically in crypto, let's take a look at some of the performance dashboards because I think we got to cover here what's going on in the market.
Mm-hmm.
So, taking a look, Bitcoin off the recent highs of last week, we're back down to like the 105 range, 105,000 price range, kind of just consolidating around there. ETH, I think, has a bullish look. It's up 17% the last 3 months, 46% in the last month. ETH's come roaring back. There's some catalysts there for ETH as a trade against BTC for sure. One being that the Ethereum Foundation has finally got its stuff together and has rooted out all the waste and is now core focus has been on supporting ETH, not dumping it, doing a lot more in DeFi, rallying around its core values. So I think that's rather bullish, just because there wasn't a lot of direction the last couple of years from like the ETH Development Foundation. Another one is that following the back of these Bitcoin treasury trades, ETH, there's going to be a vehicle now on, publicly traded stock vehicle to acquire ETH and do the treasury, trade.
Mm-hmm.
So I think that's a bid for ETH. And I just think it's been kind of beaten down and still a lot going on over there. So definitely taking a look at ETH, see if this momentum continues. Solana, a little less so. I think kind of has consolidated in this 150 range. A lot of the meme coins hype has died down, not some like almost too saturated.
Mm-hmm.
So it's kind of like people don't really,
Needs a new narrative.
Needs a new narrative, essentially, yeah. And then XRP, Ripple, always an interesting trade, I think, because you got Ripple USD, which is a stable coin backed by Ripple, which I think is pretty interesting,
Mm-hmm.
that the collateral's backed by Ripple itself. And then, just ton of development by Ripple too. So let's see what else we got here.
Look at that green for Aave.
Aave, yeah. So this is specifically one that Ryan is trading.
Mm-hmm.
I think he put this trade on early this week,
Mm-hmm.
and 60% up move in a month. So definitely bullish there.
Comp is interesting.
Yeah. DeFi, it's like the DeFi narrative.
Uh-huh.
Aave, Compound, stuff that makes money. Both of them are revenue generating protocols. So always good to go back to fundamentals. I think there's a lot of ideas here. Here's the volatility table. Weekly
Quick question in chat from Wet Juice Box. Theory, trenches aren't oversaturated. There's simply a lack of participants currently. Okay. And then he's got a question. What is Aave's end goal?
I don't know what Aave's end goal is, but I believe that Aave is a very profitable DeFi protocol and is basically a core primitive for borrow lending, capital efficiency, and just generally supporting the broader DeFi ecosystem. So, if people want to accumulate and just place a bet on protocols that have revenue, that's Aave. If people want to speculate and try and be early to things, then I agree with Juicebox. Like there's definitely some alpha to be had in being in the trenches and trying to trade these meme coin narratives. But I think for what I look at, I'm kind of leaning more toward betting on DeFi, revenue generating DeFi protocols. Aave, Compound. You can even look at Jupiter on Solana. I know Juicebox is a big Solana guy. I got another chat from JDD. So I look at tokenterminal.com.
The question is, how do you analyze fundamentals for crypto?
Yeah.
Where do you research that?
So I go to DeFi Llama. That's number one. That has basically your dashboard for all of DeFi and crypto. You can track revenue, you can track stable coins, which is an indicator of liquidity, liquidity. I've shown this before, but this green line is basically how much stable coins, which are US dollars on chain, right? That's liquidity. That's what's flowing in to the ecosystem. Usually a bullish signal for activity for, trading, DeFi. Token terminal is another one which gets into more revenue generating stuff. Really there's a ton of platforms. The other one is Messari. So Messari is a crypto research platform. Does a really good job of tracking protocols, tracking activity, news, narrative. But those are the top three. I personally think for like DeFi specific, DeFi Llama is the one. So yeah, I think, you can track fees and revenues down here. So yeah.
We've got a non-believer in chat.
It's all speculation.
Yeah.
So even traditional finance, it's all speculation.
Mm-hmm.
So. But despite popular belief, there are protocols that make revenue, that are profitable, that support billions of dollars of liquidity. You can track it. I dropped the links in the chat. If you want to stick your head in the sand, and there's other places, obviously, so it's fine.
So back to those dashboards.
Yeah. So I want to kind of talk about the expected move here and then get into our follow trade, because our follow feed for crypto is now live on the platform. We can take a look and see what Ryan's trades Ryan's placing. So yeah, Bitcoin, I think it's consolidating in like the 105,000 to 100,000 range. ETH, probably, I think there's more upside on ETH. That's just me personally, not advice. Just, I think there's a lot of bullish momentum backing ETH. I think it's been beaten down for a while, and I think it'll catch a bid here over the next couple months. So definitely pay attention to that. And Solana's probably, I think that narrative's ran out a little bit. So we'll see what catches new there. I think Bitcoin Fi and like some of these synthetic Bitcoin products are flowing into Solana. So we'll see what happens with that. But back to our original thought, we have follow feed now on the platform. So
let's clarify. Follow feed is not new.
No.
Ryan being followable is a new addition. And so, yeah, you just simply go, if you have your Tasty Trade account, you go to the trading tab, you go to the follow feed on the left sidebar, click Ryan, and you can see his recent trades, which is the alpha. Because look at the Aave. If you were following and duplicating what Ryan is doing, he got in at 251, and right now it's 265.
Yeah.
Mm-hmm. Well done, Ryan.
Good trade, yeah.
Yeah.
So I think we said that he's going to be placing a couple of trades a week. So I would be paying attention to that, because he's the guy, he has the signals. I'm not the guy, he's the guy. So.
Well, and he did say it's an us thing. It's the Tasty Crypto, we're all placing these trades. Ryan's the big brain of the group.
Yeah, exactly.
So let's just give him, the majority of mind share on these moves. But yeah, awesome resource to have at your disposal. You can follow, and you can filter by crypto and see what all of the traders are trading. I don't know, Dan, if you can show that really quickly to filter by crypto. I think it's, if you go by strategy, I think it's in there. Yeah, crypto.
Okay, cool.
And then reset who you're following. Like just put it to everybody, and you can see that Tom is trading, and so cool to follow.
Yeah,
to look at.
We'll be giving you updates in our weekly newsletters too about what trades are being placed and what we're looking at. I think trying to get more actionable trades on, and just stuff you can follow and easily tail. Mm-hmm. So yeah, I think number one, that Aave USD trade by Ryan, good trade. I think he's also talking about putting Compound on. So Compound was something that is on the platform. It's another DeFi borrow lend protocol, makes money, and has stable coins backing it as well. So definitely something to pay attention to. Mm-hmm. Yeah. Let's see.
And we just put out a couple of new how-to real quick snippet videos on the Tasty Crypto YouTube channel because we're trying to answer some questions that we get in our support tickets with videos.
Right.
And so there's a new playlist evolving over there. So if you're not subscribed to Tasty Crypto on YouTube, please go join us over there.
Yeah, and I think like in the chat, I see Theta Trader, great point. It is a space that's full of vaporware. It is a space that necessarily, hard to track fundamentals, or at first glance, it's hard to track fundamentals. But that's why it's such a great trading venue. It's all volatility. You mean to tell me you don't want to trade volatile assets? Like, what are you going to do? Like, you're talking about 20, 30% moves in a day. It's fun to trade, right? So, we are focusing on educational videos to help demystify some of this stuff. So we'll be posting more YouTube videos to the Tasty Crypto YouTube that are just more educational, more how do you take advantage of some of this stuff? How do you trade it? How do you fund your account with crypto? Some of that stuff. So hopefully they help. I think definitely something we'll be focusing on long term.
Absolutely. Theta Trader saying, I'll look at fundamentals after Fartcoin and Shiba die off.
You don't think there's a fundamental behind internet culture? I do.
There's an argument there.
Fartcoin, Shiba Inu, Doge, memes have value.
Mm-hmm. Absolutely. Culture. Culture is a powerful, human behavior.
Yeah.
Is a fundamental. He says that, yes, that was my point. Trade it because it's a risk asset you can trade, not because you think there's some fundamental case for most of these.
Yeah, of course. Mm-hmm. I mean, totally agree with you. Great point. But I am saying that if you have like a traditional, whatever, discounted cash flow or whatever fundamental analysis outlook, there are protocols, applications out there that do generate significant revenue for the space compared relative to the space, right? I'm not talking about NVIDIA or Apple trillion-dollar companies, but if you track over the last couple of years, I think there's a ton of projects that make revenue.
Mm-hmm.
But to your point, maybe not as fun to trade as a Fartcoin or a Shiba Inu, right? Definitely a risk-on asset. Definitely when 0% interest rates, money printing, debt palooza, an asset you want to be in for sure.
Mm-hmm.
I think you can definitely argue that you're not trading it because of fundamentals, right? Maybe you buy and hold some of these projects thinking that down the line fee switch will turn on and, it's...
CK calls the crypto charts the purest expression of human sentiment because they aren't manipulated like most other equity markets. I see a 12-step program for crypto traders in the future, just like Gamblers Anonymous.
I like that. That's good.
Yeah.
That's a good, I like that.
Uh-huh.
Crypto Traders Anonymous.
Yeah. CTA.
No, but in all seriousness, I think there's some truth to what you guys are saying, right? Like, I think more than anything, the attention that's gathered in the space comes during these huge volatility spikes or around things that are very bizarre, like Fartcoin. Why does that have value? It has value because other people think it has value, and internet culture is strong.
Do you want to show them Cookie.fun just to illustrate Mindshare?
Yeah, we did this on our other show, Tasty Crypto Show, or
Beans.
Tasty Crypto YouTube, Beans.
Mm-hmm.
There's actually a way to, it doesn't look like I can, let's see, Cookie. There it is. So a lot of things in this space, going back to sentiment, can be tracked. So there's this tool, Cookie.fun. It tracks Twitter sentiment and general, vibes. So you can see over the last year or 24 hours, but I can go year to date, what projects have had positive sentiment, which have had bad sentiment. So obviously Bitcoin, it's the king, Ripple, Tron, Hype. These are projects that have been trending positively on X, YouTube, other platforms. And, something you can act off of shows price, shows mind share, which again, mind share is just attention, right? It's what people are talking about. So I think
it's a good way to predict behavior.
Yes.
If popularity or, conversation is a predecessor to purchasing.
Right.
Yeah.
And I clicked into Aave. Aave is obviously a token we were talking about. We support. Ryan made a great trade on. It gives you a lot of information around major voices talking about it, and then sort of tracks sentiment and mind share as, over certain time periods. So I think it's very helpful because, to your point, chat, a lot of this is human sentiment. A lot of this is mind share, right?
Mm-hmm.
I'm a little jaded. Theta Trader says I'm a little jaded because I've had these arguments with people about the value of syrup pools and cake, for instance. The sentiment goes, and so does your investment. Skill issue? I don't know.
You got to know when to get out.
Yeah.
Just like anything. We are out of time, but before we go, I did want to shameless plug our Beans episode this Friday. We have Dr. Drip. If you can pull the link to the tweet just to show
sure
the graphic so people can see that this Friday, 9 a.m. Central, 7 a.m. Pacific, Dr. Drip is going to be on the show with us. He's an incredible trader, builder, early adopter of all things crypto and Web3.
Yeah.
It's going to be a really cool
somebody
episode.
Who's deep in, knows trading, knows what's hot, knows
maybe in like the deepest trenches.
Yes.
Yeah. So it'll be an interesting conversation. Yeah. So thank you, chat, for being here. Thank you to everybody that's watching on X.
Yeah, and real quick, chat, if you ever want to talk to us, I love the banter. I totally agree with you. We want to help you at the end of the day. I know that there's a lot of questions around this. Email us, email me, Shelly, support@tastycrypto.com. We'll answer your questions. I'll get on a call with you and chat with you about anything. Mm-hmm. So we want to help you and love hearing, the
good,
banter.
the bad, the ugly, all of it.
So appreciate it. I'm Dan.
I'm Shelly.
Peace.
Dear Kaylee, hats off to you for being such a culinary genius. I don't think it has ever dawned on our kitchen staff to serve gazpacho hot. Sincerely, Bob.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
I don't want to fact check you with my vagina, but I will.
From the smart mouths at tastylive.
If you missed the live show, here's our cherry on top weekly recap. How was Nashville? Did you go hiking? You were going to do a bike, you were going to go fishing, and you were going to visit an apiary.
I spent the most time of anything lying in a mineral pool.
Oh, gross.
There was a guy running the fishing area, whatever. He hands me a
fishing area.
He hands me a fishing pole, and he goes, here, you're all set up. He goes, want me to show you how to use it? I go, I don't need any help. I got this. I get down there. I do this. The whole thing got tangled up.
Mom, phone. I need help. Get the guy over here.
I wave the guy down. I go, hey, need a little help. He goes, let me get you another rod. Now let me show you how to do it. I made the obligatory stop at Buc-ee's.
Oh, how was Buc-ee's?
It's 6 hours away from here. I'm talking it up the whole way down, telling Corinne this is, life-changing.
Did you go into the bathroom?
No.
You didn't go into the bathroom. You can go to the dirty shell down the street, or you can go to this beautiful, clean mecca of a place. Relieve yourself.
I'm not sure what place you were looking at, but I almost got run over in a stampede at that place.
Oh, you got to move
I like how
quickly
you're
'cause
clutching
people are
your
getting-
pearls.
It is not a beautiful Mecca. Okay.
It's a beautiful Mecca. When you're on the road for
it is an absolute up for grabs show with 1,000 people running around grabbing stuff, eating
That
stuff.
is like crack for me.
There's like barbecue sauce flying all over.
Yes.
That place is not a beautiful Mecca of anything.
Who do you think the best dressed on-air personality is of all the Tasty people?
I'd probably guess I got to go Ilya.
Ryan Grace, easily.
Oh,
yeah, Ryan Grace, 100%.
He's very preppy looking. It doesn't do anything for me.
Oh, who's the guy who's God on the research team? He's got to be in that top 3 too.
Oh, Gad? Yeah, Gad's up there. Yeah.
He throws on a leather jacket, man. He comes in there looking like Eddie Murphy off Raw or something like that.
Oh, yeah,
He's got incredible confidence, and good on him.
So, Dr. Jim, throw him out. He's horrible.
Jim wears children's clothes. It's easy for him to dress.
This is
easy.
Like Granimals.
Yeah.
You can throw me outside. No, don't worry about it.
Oh, I'm throwing you out because you got
yeah.
old man Italian clothes. Yeah, I don't. That doesn't do it for me.
Tony looks like if you saw him at a bar, he'll offer to pay your cell phone bill.
Get the full scoop by checking out the archives at tastylive.com.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Tasty Live's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging, and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
All right, Mike, we have earnings coming up next week in a time of high volatility and a lot of uncertainty. What advice would you give to traders in terms of attacking earnings in a time like this?
It's a great question. I think every so often we have this pocket of time where everyone is talking about the same thing. When Bitcoin and crypto came out, we had Radio Shack talking about it. We had a coffee roasting company talking about it. Now I think you're going to hear a lot of tariff implications. So there's going to be a lot more heightened implied volatility in that weekly cycle where earnings are. Just doing your due diligence, have an understanding of what might impact the company you're trying to trade and how potential tariffs might impact that.
And what would you say your earnings checklist is? What criteria do you look for in a company if you're going to try to make a play on earnings?
You have to be really small. Even when you have a super strong assumption, you can be really wrong with earnings. The options market's closed when the earnings come out. You can't adjust unless you're hedging with stock, which I would say maybe size down more than you normally would. Stay defined risk. Just because a company reports good earnings numbers doesn't mean the stock is going to go up. Just be prepared for a lot of uncertainty.
What's up, everybody? Check out my new series, Life Cycle of a Trade, where I show you my real-time trades with insights into strategy selection, adjustment mechanics, all the way to the closing order for all of the Tasty Live core strategies. All right, so the X date on a stock, what does that mean?
The X date for a stock refers to the X dividend date, which refers to the dividend of that stock. So if you have a short in-the-money call and the extrinsic value is less than the implied dividend, then you would be at heightened assignment risk. So the X dividend date is something you want to make sure that you are aware of so that you can either roll or close that position to avoid that extra assignment risk. What does it mean when you hear the term pin risk?
So pin risk refers to options that are usually on a round number and the risk of a pin at the end of the day or the end of the expiration for that underlying. So this typically is applied to SPX or very liquid underlyings that have monthly or weekly expirations where the stock price or the ETF price or the index price is right at an even number where a lot of volume and open interest is.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
When you've got a futures contract that's in contango, what does that mean?
Futures, unlike stocks, have multiple prices appropriated to them. That's known as the forward curve. So when a futures forward curve is in contango, that means that the front month is trading cheaper than the corresponding futures back month. So you'd see that forward curve most likely looking like this in terms of prices.
And backwardation, what does that mean for futures contracts?
Backwardation is the opposite of contango. So where contango front month futures contracts are trading cheaper than the back months, backwardation is the opposite. So those front month futures contracts are trading richer than the corresponding back month contracts.
Having trouble understanding what your trader buddies are saying? Here's what it means when they say catch a bid. The term catch a bid is in reference to the stock's price action. The bid price is the price at which you can sell a stock at. When a stock continues to go down, so do bids, meaning the price at which you'd be selling the stock is continuing to go much lower. If you miss it, you can't catch a bid. So Tom, what is your definition of underwater?
The futures close 15 minutes after the cash markets close. So underwater means when the futures close under fair value, under the cash price.
If you're selling in the hole, what are you doing?
Oh man, if you're selling in the hole, you're puking. That means you're selling it at a price you don't like, but you have to do it because it's hurting too bad.
Tom, in the pit, when somebody would say it was an out trade, what would that mean?
An out trade's a mistake. That means one person thought they were doing one thing and the other person thought they were doing something else. And so an out trade is just another word for mistake. You can use an out trade in anything in life. When you just have a misunderstanding, that's an out trade.
When Tom says double whammy, what does he mean by that?
Ooh, double whammies when you roll down calls because the stock's going lower, and then all of a sudden the stock goes higher and you start rolling up puts, you're getting double whammied.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Calling all traders. Are you using tastylive mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you.